One AI company just committed to spend over $1 trillion while burning $3 for every dollar they make. Their CEO is having public meltdowns about their spending habits. They're breaking promises about ads. They're planning an IPO because private money has run out. And despite all of that capital, they can't seem to pull ahead of competitors who are spending a fraction of what they are. This is the company everyone thinks is leading the AI race. The math tells a different story. Let's talk about why OpenAI might be the first major AI company to fail. So let me set a little bit of context here. I believe that the AI LLM platform market is a game of winner takes all, or at least winner takes most, kind of like the search engine wars of the early 2000s. And if that's the case, there's minimal room for this many competitors. Some company or some companies will fail. And according to Carnegie Invest, quote, OpenAI looks like the most fragile of the big AI hyperscalers because it combines the highest capital intensity and commitments with the weakest structural moat and profitability profile relative to players like Google, Microsoft, Amazon, and potentially Anthropic, end quote. Yikes. That's a pretty definitive analysis of why OpenAI might be the most likely of the AI platforms to fail. So what makes OpenAI so fragile? Let's start with some of the numbers. HSBC and others estimate OpenAI has projected $792 billion in cloud or AI infrastructure costs between 2025 and 2030, with total compute commitments towards $1.4 trillion by 2033. According to Jane Zhang, quote, Deutsche Bank cited a forecast disclosed by OpenAI showing that OpenAI's cumulative losses before achieving profitability could reach as high as $143 billion. OpenAI forecasts revenue of $345 billion between 2024 and 2029, but expenses for computing power expected to reach as much as $488 billion. Furthermore, this projected $143 billion loss does not include OpenAI's recently announced $1.4 trillion commitment to data center investment, end quote. And then TradingKey provided some basic but kind of crushing arithmetic. OpenAI is spending $3 for every $1 in revenue. Ouch, that's some seriously shitty unit economics. And despite how Sam would try to spin it, you can't make up for that in volume. You know, one of the best ways to support small YouTube channels is to subscribe to the channel. So if you're enjoying this content and like to see more of it, consider subscribing. Back to the episode. And all of this means OpenAI has a runway problem. While we don't know for sure because OpenAI is still a private company, it is widely believed the company could run out of cash by mid-2027 because it's burning $8 to $12 billion per quarter and had about $17.5 billion in cash midway through 2025. Again, this is a private company. They don't disclose these numbers, but there's so many people looking at this company, these numbers are probably pretty accurate. Now let's compare that to their competitors. Anthropic is projecting a fraction of that spend on an annualized basis. And while Anthropic reports much lower revenue than OpenAI, estimated by Bloomberg to be about $9 billion in 2025, they are committing to a $50 billion build-out. Even annualized, that number comes to less than half of what OpenAI has already committed by 2030 and a fraction of what they've committed by 2033. So how did OpenAI get here? Believe it or not, I think they raised too much money. I know what you may be thinking. Aren't all these hyperscalers underwater? Haven't they all raised too much money? Yes. But OpenAI's lagging growth and indulgent spending plans are creating a figurative tinderbox. From my perspective, OpenAI, after raising tens of billions of dollars, doesn't have the massive lead to show for it based on that amount of money raised and spent. And OpenAI isn't alone here. All these platforms have raised billions. But it's estimated that OpenAI has raised about the same amount of money as Anthropic, somewhere around $65 billion. But it's now rumored OpenAI wants to raise another $50 to $100 billion on a valuation as high as $800 billion or more. Quick math says that's a valuation representing a 40 times sales to price ratio. All that capital and they still seem impressively fragile. Even the circular deals seem sketchy and unsustainable. OpenAI's deals with Oracle, AMD, NVIDIA, and Broadcom involve customers becoming investors and investors becoming customers. And Jensen Huang, the CEO of NVIDIA, recently walked back his $50 billion circular, quote, investment commitment to OpenAI. As a matter of fact, he made it sound like he never actually made that commitment, and it was very contingent on certain benchmarks that OpenAI was supposed to hit and apparently hasn't hit, at least from his perspective. And the problem is that they've all raised too much. That's really the bottom line. And they've raised it on too high a valuation to stay private. They have to go public at some point in time to keep raising more capital. And going public is a great way to raise more money, but it's at a price. There will be more scrutiny from investors. There'll be more scrutiny from the public who are trying to figure out, did I just make a good investment or did I just sign on to the hype train or buy a ticket on that hype train? And there's going to be inevitably more pressure on growth. The unit economics and profitability, or at least a clear path to profitability, is going to be important to those investors, to the public markets. And that's exactly what OpenAI is supposedly working towards, an IPO. Now, skeptics will say this is the only path forward, and I happen to agree with them. Private markets won't or can't keep funding these AI moonshots. There just isn't enough capital supply in the private markets to keep this race going between all of these LLMs, all of these platforms, all of these AI companies over the next $50 to $100 billion in private capital, which leaves the public money and the proverbial dumb money of retail investors who might care more about saying they own the stock than realizing any upside value in it long term. All this while private investors sell off their shares in the public markets because they've endured years of illiquidity while being able to capture returns of 500% or more. The underlying demand shifts to smaller public shareholding investors. But which of the hyperscalers IPOs first? That's another potential issue because whoever goes first will set the market for the rest. If it's a dud or quickly becomes a broken IPO, the rest will delay. If it's a huge success, they'll all line up in a row like a freight train. And all of their financial problems or entanglements are compounded by their biggest dependency. One distinguishing difference between OpenAI and its nearest competitors is OpenAI is reliant on Azure, which is at least partially because Microsoft was a major early investor in OpenAI. Anthropic, for example, splits its compute costs between Google and AWS. Google, in turn, uses less expensive TPUs, and by leveraging two providers against each other, Anthropic can force competitive pricing. And speaking of Microsoft, they are currently actively building their own AI models to replace OpenAI. They stopped providing training infrastructure in April of 2025. They added Claude, Anthropic's product, as an alternative chatbot option, integrating it directly into their flagship product, Copilot. And not to harp on this issue, but let's get back to their spending problem. Maybe all that spending could be justified if they were dominating technically, but they're not. OpenAI doesn't appear to be able to maintain any kind of market leadership despite all of that capital. DeepSeek's R1 model matched OpenAI's performance at a claimed 1/100th the cost. OpenAI has accused DeepSeek of stealing their IP through, quote, distillation, basically confirming they couldn't stop the Chinese from tapping their model. Even more of a signal? Sam Altman admitted Chinese competition influenced OpenAI's decision to release open source models. Basically, he waved the white flag. The efficiency breakthrough by competitors undermines OpenAI's entire spending thesis. Remember those user growth numbers, only 5% while Gemini grew 30%? They can't pull ahead despite massive spending, and competitors are matching them at 1/20th the cost or better. And it's not just DeepSeek. If you look at the most trusted AI benchmarking test, the latest Codex release from OpenAI appears to catch up to other competitors' models more than it passes them from a performance standpoint. And prior to this new Codex launch, ChatGPT led few, if any, benchmarks, coming in second or third in almost every measurement. According to TensorLake, GPT 5.3 Codex excels at fast execution, agentic coding, and end-to-end workflows, making it a strong choice for building and iterating on real systems quickly. Claude Opus 4.6 stands out in reasoning-heavy, structured, and long-context tasks, especially for data analysis, reporting, and document-driven work. The right choice, according to Tensor, depends on workflow needs, with Codex favoring speed and iteration, and Opus favoring depth, clarity, and consistency. Still, others think it's too early to tell. Specifically, developer threads on Reddit note that GPT 5.3 hasn't yet appeared on major public leaderboards because API access is still constrained, making it hard to position objectively against its peers. But all of these companies may be, quote, hitting the wall, where today's LLM paradigm is running into limits on available data, economically viable compute, and stable reasoning. So future leaps will require qualitatively new ideas, including better architectures, training methods, or hybrid systems, not just more GPUs and tokens. And OpenAI seems to know they're in trouble. You can almost smell the fear. Sam Altman, the CEO of OpenAI, had a meltdown on the Brad Gerstner podcast when Brad asked him about how they are going to fund the $1 trillion plus in spend they already committed on the $12 billion in revenue they generated. And Sam's response to Brad was that he would find him a buyer for Brad's OpenAI shares on the secondary market, which is a very defensive and childish response. Sam Altman also allegedly called a, quote, code red inside of OpenAI as he believed that ChatGPT had fallen behind competitors' models in its performance and capabilities, and was asking everybody to effectively double down on their efforts to catch up. And then Sam said that ads inside ChatGPT were a last resort, that if they had to add those advertising messages into the model, that was a bad sign for the platform and for the growth of the company. He's now confirming plans to bring ads into their model. Now, I don't know if you've noticed this, but there's a lot of national advertising and marketing spend towards this new Codex release. And I don't remember that ever happening in the past. It seems that truly outstanding models never really needed media marketing before. They just kind of went viral organically based on some step change in quality or capability. Now, I've alluded to this kind of throughout the episode, but maybe the biggest problem isn't actually the tech or the money, it's the person at the top. Sam Altman, the CEO of OpenAI, is not well liked. According to an aggregate of YouGov polls, only 25% of Americans polled have a favorable view or opinion of Sam Altman. Now, I think that's general AI backlash, and he's just the biggest target of that. But he has earned some of that unfavorability. He routinely overhypes his own company's capabilities while alternating between lavish self-praise and doom predictions about job displacement and how AI could kill all of us. He's actually said that. And it's not just the general public that's pushing the, quote, scam Altman type narratives. OpenAI's competitors and industry skeptics have decided to project OpenAI as the villain of this story. Founders at Stability AI, Hugging Face, and others have repeatedly attacked OpenAI's secrecy and closed ecosystem in interviews and social posts, arguing it misleads the public and stifles open innovation. Elon Musk sued them for, quote, abandoning their nonprofit mission. And let's not forget, Sam was fired for like 48 hours by his own board. And then there was Anthropic's Super Bowl ad that basically made it sound like ads would be included in every ChatGPT response to prompts. And if you didn't think that ad was a big deal, you're probably right, but Sam's reaction to it was. After seeing the ad, Sam wrote a lengthy and defensive post on X that included, quote, I wonder why Anthropic would go for something so clearly dishonest. Our most important principle for ads says that we won't do exactly this. We would obviously never run ads in the way Anthropic depicts them. We're not stupid, and we know our users would reject it. I guess that's on brand for Anthropic doublespeak to use a deceptive ad to critique theoretically deceptive ads that aren't real. But a Super Bowl ad is not where I would expect it, end quote. And Ed Elson framed this best when he said Sam Altman's reaction was far more damaging than the Anthropic ad itself. Now, let me be clear. None of these AI companies are in a particularly strong position. They've all raised too much money and made too little progress from my perspective. They're all built on increasingly fragile capital stacks, and they can't help themselves when given the opportunity to overpromise and underdeliver. It's just that OpenAI may be the most vulnerable pure-play AI platform of them all. There's a relevant, if not rather morbid, saying that contextualizes all of this. And I'm paraphrasing, but it goes something like this. The frontier is littered with the bodies of dead pioneers. And maybe that's the best way to think about OpenAI and their current position. They were largely seen as the first, blazing trails in the new frontier, but now OpenAI is playing a game of financial chicken with trillions of dollars at stake. They're burning capital faster than they're building moats. They're raising on valuations that assume perfection while delivering benchmarks that suggest, at best, parity. The irony? Sam Altman's been warning us about the existential threats from AI this whole time. He just never mentioned the most immediate one might be to his own company. Will they pull it off? Maybe. Stranger things have happened, but when you're spending $3 to make one, when your CEO is writing defensive essays about Super Bowl ads, when you're planning an IPO because private money is tapped out, those aren't the signs of a company that's winning. They're signs of a company that's running out of options and, more importantly, time. I want to know what you think. Let me know your thoughts in the comments. That's it for this episode. As always, like, comment, and subscribe, and we'll see you next time.